Tesla just gave us the paradox quarter. The EV and battery business cooled, margins thinned out, and management's answer was basically, let's spend even harder on AI, robots, and chips. This is Earnings Unscripted, and on 2026-04-22, we're talking Tesla, ticker TSLA, Q1 2026.
Yeah, and both halves matter. The business they shipped today looked softer. The business Elon is pitching for tomorrow got even bigger.
Revenue was $22.39 billion, down 10% from Q4. Non-GAAP EPS was 41 cents, down from 50 cents. Operating income fell to $941 million, and margin slipped to 4.2% from 5.7%. I don't have every consensus decimal in front of me, but this was not a headline win kind of print.
Right. Deliveries dropped about 14% sequentially to 358,000 cars. Energy storage deployments fell hard too, and Tesla more or less admitted the car math got worse from lower selling prices plus subsidized financing. Services kept growing, and FSD subscriptions climbed to 1.28 million. So it wasn't all bad, but the core auto engine was clearly under pressure.
And the stock, wow. After a quarter where shares had already slid more than 22%, after hours turned into theater. It spiked near 406 right after the release, then sold off into the call to roughly 377, and somehow ended almost unchanged.
Which is kind of perfect. And tiny legal sprinkle, these are just our opinions, not financial advice.
Okay, but why that round trip? Because the release and the call almost sounded like two different companies.
That's the crux. Current Tesla is, still mostly an EV and energy storage company, and that Tesla had a weaker quarter. Automotive revenue was down, energy revenue was down, operating profit dropped a third. Then future Tesla walks on stage and starts talking about AI 5 chips, Optimus, Robotaxi, a $3 billion Terafab chip plant in Texas, and more than $25 billion of CapEx for 2026. Investors were ping-ponging between those stories in real time.
Yeah, and one thing that looked almost too pretty was energy. That margin number kind of glowed.
Too much glow, honestly. Energy gross margin hit 39.5%, which sounds incredible, except management said it included a one-time $250 million tariff benefit from prior quarters. So the segment helped save the quarter optically. Free cash flow, meanwhile, was $1.44 billion, actually up a touch from Q4. But the tone around cash got much darker.
Because they basically said, enjoy the positive free cash flow while you can.
Pretty much. Vaibhav Taneja said CapEx for 2026 should be over $25 billion, and he openly warned free cash flow will be negative for the rest of the year. 6 factories, compute infrastructure, mega pack lines, Optimus, Robotaxi. That's not incremental spending. That's Tesla choosing to behave like a startup again while still being valued like a giant.
And then Musk gives the most oddly relatable Robotaxi anecdote imaginable. Not cars going rogue, cars getting timid.
Yeah. He described the system freezing in awkward edge cases, and in Austin, a crashed Waymo blocked the street, then Tesla robotaxis stacked up behind it in what he called an infinite loop. It's funny for about 3 seconds, then you realize that's the real autonomy problem, not movie scene danger, just software getting too cautious at exactly the moment Tesla is asking investors to fund the moonshot.
So, all right, softer cars, a flattered margin story, steadier cash than you'd guess, and a very loud bet on tomorrow.
Exactly. Now, let's pick apart whether that bet is brave or just brutally expensive.
All right, let's get into it.
Yeah, and the part I can't stop staring at is that they're not just spending more. They're trying to change what Tesla is.
Right, from car company with side quests to what, vertically integrated AI empire?
More or less. The Terafab thing is the clearest tell. A $3 billion chip fab at gigafactories tied to Intel 14A to make their own AI chips. That is not a normal extension of an auto business. That is management saying, we do not trust the external compute supply chain for the world we think is coming.
Which is such a Musk sentence, by the way. The industry cannot provide enough chips, so naturally, we shall build a fab.
Yeah, and he basically said exactly that. His line was, there's just no way in hell the existing industry can keep up with that. It's impossible. So, okay, you can roll your eyes at the drama, but the logic is internally consistent. If you believe the future is millions of autonomous cars, robots, maybe way more edge inference than the market can currently imagine, then buying off the shelf forever looks like a bottleneck.
So this is the part where you annoy me by saying the strategy is not crazy, just expensive.
Correct. Painfully expensive. Because the hidden shift here is they are moving from product execution risk into infrastructure execution risk. It's not just, can we sell enough cars? It's, can we design the chip, tape it out, build the compute stack, stand up a fab, and do all of that while the current business is softer?
And while telling investors calmly that free cash flow probably goes negative for the rest of the year. That's a bold way to ask for patience.
Exactly. 1 quarter of positive free cash flow now looks almost like a last clean breath before the bill arrives. The call made that pretty explicit. This year's cash generation is being subordinated to a future architecture. That can work, but it changes the valuation debate. You're no longer underwriting just Tesla's demand, you're underwriting Tesla's ambition.
Okay, but I think the more emotionally loaded bit was not the fab. It was the old cars, because that felt weirdly personal.
Yes, that was the real grenade on the call. Elon said, and he was very direct, unfortunately, Hardware 3, I wish it were otherwise, but Hardware 3 simply does not have the capability to achieve unsupervised FSD. It has only 1/8 of the memory bandwidth. That is brutal, because it tells you this isn't a software update gap, it's a physical constraint.
Wait, back up. In human terms, that means some people bought into an autonomy path and are now hearing, actually, your car's brain is too small.
That's it. And Tesla's answer, at least conceptually, is to create localized microfactories to retrofit older cars with newer hardware, computers, cameras, the whole physical swap. We do not have a cost number for that, which is kind of the point. It's one more future obligation floating around inside this giant capital plan.
It also changes the romance of the Robotaxi story, doesn't it? Because the glossy version is, flip us off or switch, and this enormous fleet wakes up. The uglier version is, no, first you build tiny surgery centers for your own cars.
Yes, and that's why I think this quarter was more revealing than the headline profit decline. The installed base is not a clean asset anymore. Part of it is potentially stranded for the unsupervised future unless Tesla spends real money and operational effort to upgrade it.
Which, is not a trivial footnote. That's trust, logistics, customer experience, all of it.
All of it. And it helps explain the tone on the call. On one hand, enormous conviction. On the other, this almost wartime intensity around execution. Musk mentioned the AI5 team worked every weekend for 6 months straight, including every holiday. When a CEO says that, I hear 2 things. First, the effort is real. Second, the bottlenecks are real.
Yeah. It's not polished corporate serenity. It's more like everybody in the building is living on caffeine and belief.
Right. And belief can be productive. It can also be very expensive if the timelines slip. I think that's the key nuance. Tesla is not spending like a company defending a mature auto franchise. It's spending like a company trying to force an entire supply chain, product stack, and autonomy platform into existence at once.
So when people say, why are margins weak? The deeper answer is almost because this quarter is funding a thesis, not just a business.
Nicely put. And there's one more subtle implication. If autonomy and robotics are the destination, then every legacy compromise starts to matter more, not less. Old hardware matters. Chip supply matters. Factory sequencing matters. The car business used to finance the dream. Now the dream is beginning to dictate the economics of the car business.
It's very Tesla, honestly. The future has started sending invoices to the present.
Yeah. And investors have to decide whether that's visionary discipline or just a very charismatic way to burn cash.
Which is probably the right bridge here, because if this was really a quarter about choosing the future over the present, then the next question is simple. Do you actually trust them to pull that off?
I trust the intent more than the timetable. Tesla's earned some credit on hard engineering, sure, but when a softer quarter is answered with over $25 billion in CapEx, execution becomes the whole story.
So the bull case is still there. It's just, sorry, much less comfortable.
Exactly. They have about $44.7 billion in cash and investments, so this isn't a distress signal, but the market has to decide whether it's valuing a weaker car company or a self-funded autonomy lab.
And those are two very different emotional states for one stock.
Yep. Next quarter, I'd watch three boring things. First, does the cash profile worsen the way they warned? Vibe of Tunasia was blunt. Expect negative free cash flow for the rest of the year. Second, do energy margins come back to earth once that tariff benefit is gone? Third, do we get actual proof points like Europe moving on FSD after that Brussels review in May or real Optimus V3 timing?
I like that list because it forces the future story to produce receipts.
Right. And if those receipts show up, investors will forgive a lot. If they don't, the valuation pressure gets very real very fast.
That's the Tesla pattern, kind of. The present pays the bill, the future makes the promise.
And this quarter, the promise got much bigger. I admire the ambition, honestly. I just think ambition is cheapest in presentations and most expensive in factories.
Put that on a t-shirt. So, big picture. Tesla is asking shareholders to fund a reinvention in real time.
Fair. And next quarter probably matters less for perfect earnings and more for whether the machine looks believable.
All right. 3 businesses, 1 ticker, and a very expensive imagination. Thanks for hanging out with us.
See you next time.
If you want these earnings chats to just land in your feed, you can follow the show. And just so it's clear, we make these with AI, using the company's public filings and earnings call transcript. So if you've got thoughts or a ticker you want us to dig into, send us a note at earningsunscripted@datamadness.ca. And there's an X link in the show notes. All right, take care.
See ya.